Let's take a look at Bell Canada, and this is a Canadian company, and they renamed the company to BCE. They provide telephone and internet services, and it's one of the largest companies in Canada. So what we're going to do is try to figure out the stock price using a discounted cash flow model. And let's get started with the model. The first thing we need is the market cap, which is 50.7 billion right here. Now we're going to need the stock price, which is 56.02. Now we can figure out the shares outstanding because it's a market cap, 50 billion, divided by the stock price, $56, equals the shares outstanding, 905 million. Next, we're going to get the free cash flows. And this is the actual cash that's left over after operating your business minus capital expenditures. And we'll go to the financial section, Yahoo Finance, go to cash flow, and they list the free cash flow. And the way to value a company is you have to estimate the future free cash flows of that company, discount those dollar amounts back to today's dollars, and you get an intrinsic value of the company. And that's what we're doing in the video today. Next, I'm going to pull the net income from the income statement, and that's the profit and loss. And then I'm going to pull the revenue, which is just the sales, and that's also on the income statement. We'll put that into the model. And you always want to take a look at the numbers just to make sure they look pretty consistent. And they do. Every year their free cash flow increases. Net income, it drops a little, then comes back up, but it looks pretty consistent. And revenue increases each year. So these are good signs. You also need to use some industry knowledge when you do these models. So that's why if I just email this model out to people, they probably wouldn't get as good of values as I get, because I know which model to use and which assumptions to use. Now we need the capital structure of the company so we can figure out the discount rate. So they pay 1.2 billion of interest on their debt, and that's in the income statement. We need to figure out how much debt they have. We'll go to the balance sheet. We'll go to liabilities. Then we'll go to current liabilities, which is $3.9 billion. That's current debt due within 12 months. And then long-term debt, we'll go to non-current liabilities, long-term debt of 22 billion, and that's due after 12 months. They pay 4.5% interest on the debt. Since interest is tax deductible, let's get their effective tax rate. We'll go back to the income statement. The income before tax is 4.4 billion, and the income tax is 1.1 billion. So they pay 25% in taxes. So even though they pay 4.5% on interest, that's deducted by the percent of taxes. So it comes down to 3.4%. And they have a beta of 0.28, so the stock is not volatile. It doesn't move much relative to the market. It moves actually a quarter of what the market moves. So if the market went up 4%, which is a lot, this stock would only go up 1%. Next, we need the current assets, which is $5.5 billion, and that's on the balance sheet. And these are assets which can be converted into cash within 12 months. Current liabilities are liabilities due within 12 months, and it's 9.8 billion for this company, and that's on the balance sheet. And next we need the equity, and that's the value of the company according to the balance sheet. That's total assets minus total liabilities. That's 21 billion. We also need their EBIT, earnings before interest and taxes, or operating income. And this is the amount the company earns from their operational business, but before they pay interest and taxes. And that's 5.8 billion. So now we know their weighted average cost of capital because it's a blend of the cost of debt, 3.4%, and the cost of equity, 4.5%. And the WACC is 3.86%. That's what we're going to use to discount the future cash flows. So we estimated 4 years of future free cash flows. We also estimated a terminal value, which is all years past year 4. We discounted those numbers back to today using the weighted average cost of capital. and we get a value of the company of $100 billion. When we divide that by 905 million shares, we get an intrinsic stock price of 110. It's trading at 56. So it's trading at a 49% discount. So it's a buy according to the model. Let's look at Simply Wall Street. Let's see what they calculated. That calculated at 106. So that's pretty close to what I calculated at. So it seems like a good value. Now the reason it might be trading lower is because people perceive the company's future not as strong as the present. So they're not willing to pay the 110 price. And the price is pretty consistent since it has such a low beta. It doesn't really move too much. Let's look at their financial ratios to get more information. They have a PE of 16, and the average in the market's 29, and the median in the market's 16. That's price of stock over earnings per share. That's a pretty good PE. They have also a good price to sales ratio of 2.1. That's price of stock over sales per share. So investors are willing to pay $2 for $1 of sales. Price to book of 2.4, that's price of stock over book value per share. And in this case, investors are willing to pay $2.40 for $1 of book value. And book value, remember, is total assets minus total liabilities. That's the equity on the balance sheet. They have a low current ratio, it's below 1, so they can't cover their current liabilities. That means they either have to take on more debt or bring in more revenue from their current business. Next is ROE, which is the income over equity. It's how much value the company is providing to its equity holders, and that's 15%. I like to see around 20% in a company, but 15 isn't too bad. They have an interest coverage ratio of 5, so they could cover their interest payments almost 5 times. That's EBIT over interest expense. Next is debt. So their debt is pretty good, 56%. Now let's compare this company to its competitors. So Bell is in the same industry as Rogers, which is also a Canadian company, and TELUS, which is another Canadian company. And I also have AT&T, an American company, and Verizon, another American company. So Bell has about an average PE compared to its peers. They're also pretty close to average in price to sales and also price to book. So it seems like all the ratios are about average. And if you notice, it's a pretty tight range with all the ratios. Most companies are pretty close to each other, except market cap, of course. So the only negative is their current ratio, but they're having no difficulties paying off their interest, and they don't have too much debt. So if they needed to take on a little more debt, they can. But their free cash flow is fairly healthy, so I don't think they're in much danger of needing extra funds. So let me know what you think in the comments about this company and about the video, and thanks for watching.